So I would like to start now our second session of this second day on deconstructing and reconstructing ESG, hosted by Banque de Luxembourg. And please join me in welcoming today Thierry Felgen, Head of Socially Responsible Investment Strategy and Stewardship at Banque de Luxembourg Investments. Thierry joined Banque de Luxembourg in 1919 and has specialized in various topics, including fixed income products. Thierry holds a degree in agricultural engineering and in economics and ecology. Thierry, the floor is yours.
So, good morning. I hate these, so I will stand here. I guess you have heard already a lot about SFDR, taxonomy, and so on. And when this all started, I wondered how many funds would declare themselves as Article 8 or 9. And I think authorities thought that there would be a big chunk of 6, some 8, and a few 9. But what you can see is there are very many 8. Well, the last stats I looked, the sample I saw, is the majority of funds are classified as Article 8. A few Article 6 and some Article 9. So you cannot help but wonder if now everybody is into SRI, where were they? Did they hide? Or did they see the lights and move from Saul to Paul and everything will be fine going forward? If you think about this topic, you can have some unease because you can have the impression that many actors have made a nice compliance job, being compliant with SFDR, not changing a lot, implementing some things which are not really a constraint. You say, collect the low-hanging fruit and move on to business as usual. The current president of the AMF even said SFDR fosters greenwashing. So everything might not be as good as it looks. But well, I hate the word greenwashing because greenwashing is not really defined. It's always thrown into in the audience when you do not agree with what somebody does. Greenwashing is about consciously misstating what you do. But I think everybody tried to make an honest job implementing SFDR. But my job is here today not about talking about SFDR, and you consider yourselves lucky because I could ramble on for days. I have just half an hour, so let's change topics. The subject of my presentation is deconstructing ESG and reconstructing it. So let's start deconstructing. I would like to show you what ESG can and what it cannot do. And what it cannot do is, unfortunately, what the people think it does. So, let's take one step back. If you invest in equities, in the secondary market, what do? You buy a stock from a former shareholder. You don't give money to the company. You buy a property right on this company, which has been issued years ago. So you don't give capital to the company. This capital, the company has received it years ago. So you can say there is no additionality by you moving into this market, into you buying this stock. The company functions independently of you. And that's the merit of the equity market. The owners can change, but you do not interfere into day-to-day functioning of the companies. The same thing happens if you divest. You sell your stock to another shareholder. You do not tell the company, hey, give me back my capital I gave you or somebody gave to you years ago. So if you divest in a company, the company will not be in trouble. You don't reclaim what they owe you. At the end of the day, when you buy a stock in a company, you buy a property right and you buy a right to receive income from this company. And if you think that this concept one step further, you realize that the effect between you, the interaction between you and the company is the other way around. You do not affect the company, well, unless you speak up in annual meetings, but the company affects you. You earn money from this company, and if this is dirty money, you earn dirty money. Well, dirty, you know what I mean. And if it's a virtuous company, you have the good feeling of being a co-owner, being co-responsible for a good company. So if you would like to be a little bit cynical, you could say this is wellness asset management. You feel well because you own a good company. There is one detail which is a little bit dissonance to this. If many actors don't like a company or divest or put a company on an exclusion list, like for example coal, which is happening right now, then the stock price will be in trouble. The stock price will have trouble rising. The income will be the same because the company you don't give money to the company, as I said, but the stock price does misbehave. And the directors hate that because their pay is linked often to the stock price. And if the stock price has trouble rising and delivering the performance they have promised their shareholders, they might be in trouble in the annual meeting. So they don't like that. So they might, just due to the fact that there will be market pressure on the price, they might change their ways. But this is where SFDR comes in later. We come back to that later. The same story holds more or less true for the bond markets. But, well, with bonds, you know, it's always a little bit more complicated. In contrary to the equities, bonds have maturity. An equity is issued without maturity. Well, unless the company buys it back, it will stay out there forever. Well, or it goes bankrupt. That's the other possibility. The bonds have maturity. So a company, when a bond matures, either pays it back or rolls it over. So it needs to issue new bonds. And if there is a general denial of credit, their spread, their yield will rise. So they will be in trouble refinancing. So the effect, well, again, the company will function independently of the bondholder, because again, if I buy a bond in the secondary markets, I buy it from another holder. But if there are less buyers than sellers, the yields will rise, and at the maturity of the bond, the company might be in trouble. But there's more to it. There are green bonds, bonds which are issued linked to a certain project. There are sustainability bonds, there are social bonds, bonds that are issued with a certain project it's supposed to finance. Well, then you need to be careful, because sometimes you see green bonds which are issued to finance a water withholding basin for a new airport. Well, the water basin is green, but the airport, well, if they didn't build the airport, they wouldn't need the water basin, but well, another story. So in the green bond area, if you find good green bonds with good projects, there you can have a certain impact. Because if you provide credit to a company through green bonds and not investing in the brown bonds, they will be an interest, they will have a certain interest in issuing more green bonds, in financing more green projects, because the yields on the green bonds will fall and the yields on the brown bonds will rise. But that, again, that's still at the margin. It's not very deep inside. Banks have another possibility. If they deny credit, they deny credit. So the company will not have credit, period. But that's another story. So now you could wonder, well, why bother? If the real-world effect I can have is so limited, why bother constructing ESG portfolios, thinking about how you do this, investing in databases, providing with information, thinking about what's a sustainable asset, if the very simple fact is that if you invest in it or not, it doesn't change much. Well, let's start reconstructing, because there are many things you can do, and the balance is much more positive than you could think. The first step is, if you're a financial asset manager, you care about the risks your companies have. And extra financial risks, which are pushed now, thanks to SFDR and thanks to the SRI drive, they are very relevant. Consider a brewer who is active in an area where, due to climate change, there will be lack of water. Well, if they don't consider this risk, they will be out of business in a few years, because the effect of drought can be very, very quick. Or if you have a company that's built their production lines in flooding area, well, you can have massive disruption due to that. And that's a very financial risk. That is not just planting daisies and counting the bees, but it's really about pure financial risk. Then, again, you see the face of SFDR popping up and again. This pushes the whole industry into a certain direction, excluding coal, excluding hydrocarbons, excluding tobacco, excluding any more or less controversial activity. If you're early in identifying these trends, you will avoid financial underperformance. Because consider tobacco. Tobacco is slowly but surely on the exclusion list of every European asset manager, because it's obvious. This means that the income of tobacco companies won't change because, well, they have to do with addicts. They will consume the tobacco, so the dividends will be solid. But the stock price will be in trouble. It won't rise. It will be on a downward trend. And for the tobacco company, it might be even good because they can buy back their stocks for a good price. But for the investor, it's not necessarily good news. So if you want to avoid investing in stranded assets, for example, coal which you cannot remove from the ground because, well, everybody says, well, you should not burn coal to make electricity. You will be the owner of a great asset, of a massive asset, which you cannot use. Same holds true for oil and gas and so on. So extra financial research will be a huge added value for a financial asset manager because they will know early the trends that will happen to their industry. But there's more. You can have a direct impact on a company, but to do that, you need to be invested. You can speak up at annual meetings, but well, okay, at BLI we have 20 billion of assets under management. So we will have a couple of million per company. Well, if you talk to a multi-billion company, it will be a joke. They won't consider what you have to say. And if you send a letter to Amazon saying, well, the working conditions in your warehouses are not good, they will put it on the pile of all the other letters they have received and nothing will change. And well, anyway, engaging Amazon is difficult because they are too big. But there's a possibility now which is unprecedented. There is collaborative engagement. You can connect to other asset managers and increase your weight. And if you have increased your weight, then your weight in the annual meeting will count. And it can even go that far that you can reach a level where you can submit motions that need to be discussed at the annual meetings. If they get voted by the rest of the shareholders, that's another story. But you have a seat at the table with the company and you can discuss with them and bring things to life. We had one very interesting situation recently. We tried to talk to a Chinese company that was into the coal business to understand what their projects were, how they wanted to reduce the carbon emission footprint, and so on. They didn't answer. They simply did not answer any emails, either by the fund manager or by the SRI team. We found a collaborative engagement that had been submitted by one of our competitors, and we took that train. The consortium we had was worth $600 billion. So from our 20, we went to 600, and they still didn't talk to us. They didn't answer any mail, any letter, anything. Until the day where all the asset managers in this group said, okay, if this is the game you play, we will all vote against the directors at the next annual meeting that we consider responsible for this policy. And suddenly they talked to us. And they were very positive discussion. We understood better how they work. They understood better European regulation. So there was a virtuous cycle that started. But the issue with all this is that this is very time consuming. So at our company, we are 4 people working in SRI. This project with the Chinese company cost 1 person 2 weeks. We have 400 companies we invest in, so count it. 400 by times 2 is 800 weeks to engage each and every company we have once. Well, I have 52 weeks in a year, so it would be, we could create some jobs, but then again, jobs cost money. So if you want to go down that road, where you can have a real world effect on the companies you invest in, you need to choose well. You need to choose the right projects, you need to reach the right topics, the right companies, and if need be, the right allies to push your message to the company. And then there you have, if the company changed something, and if it's only a report they send, they will produce on an ongoing basis, this will be an effect, a real world effect you can claim. The Global Impact Investors Network, the GIN, recently issued a white paper talking about what is the real world effect a secondary market investor can have. And they made a very interesting point. They said you need to make the difference between the impact of the company and your impact, and the investor's impact. Because, as I said before, the impact of the company will be independent of the investor. And they stated 2 ways where you can generate impact as an investor. The first is to be a patient investor. What means a patient investor? If you're a patient investor, you will not sell just for financial reasons. Imagine a company goes down, and instead of selling, you buy and you stabilize the equity price, and you avoid the company of being in trouble at the next shares issuing. But again, this is a little bit indirect, and the GIN holds the view that the engagement is the key area where you can add value. I would add that if you invest in a company at an IPO, there you give the company directly money, and then you can claim also the effect of the project the company has financed with this IPO. So, this looks a little bit blunt. It looks a little bit, well, underwhelming, because what you can directly do is limited, and unfortunately, the nice story, the nice wish of having a simple solution for this very complex problem we are facing, well, it just doesn't exist. And there is no reason why it should be easy, because we have created this problem over years. We cannot change it by just saying, okay, now we invest in good companies, period, everything is going to be fine, so we go to the beach. That won't work. But while I said that individually, every investor, as big as he or she may be, will have a very limited effect, if we have a federating effect element, then things change. And that's what the European Union is currently doing. Many say SFDR is a monster, and it is. I have the pleasure of implementing it at VLI, and only understanding what they want from us took some time. And every day we discover new things, because they also change the rules of the game in between. But still, what SFDR is a monster, but it's a very good monster, because it pushes the whole financial industry in a certain direction. We have this tractor beam, Star Wars, this tractor beam pushing everybody in the same direction. Everybody's talking about excluding coal, hydrocarbon, tobacco. And if everybody does it, it will have a real-world effect. If you don't have this federating effect, if everybody moves a little bit in his own direction, well, it's diffuse, it's diversified, and it will not have a direction. But this has direction. And to come back to the first comments I made about Article 8 and 9, you can say banks and asset managers are between a rock and a hard place, because the European Union has not just made SFDR. We have CSRD, so the Corporate Sustainability Reporting Directive, so the companies need to provide us with the information that's required. Then we have SFDR. We as asset managers need to tell what we do. We need to be transparent, and especially what we need to provide the investors with is how many sustainable assets we will have, how many taxonomy-conform assets we will have, and if we consider negative externalities, so the famous PAI. Then we have MiFID ESG, where the distributor needs to ask his client, what do you want in all this? And the client who thinks he's judged, that's answers we receive from some clients where we have, whom we have submitted our questionnaire, and who has not analyzed the whole topic in the depth will have a gut feeling decision. And investors will put the cursor a little bit higher than we would like it to be. So we have to move in this direction. And then again, banks and asset managers don't have normally 3 product lines, one for the client who doesn't care, one for the client who cares a little bit, and then one for the client who does really care. In general, you can say the client who care a little bit will receive the same thing as those who don't care. So the central argument will be you need to have Article 8 funds with everything that goes with it, with all the reportings that go with it. And since you have to measure it, since you have to go down that line, you will play the game. You will exclude. You will manage the sustainability data and so on. And this means that this federating effect of SFDR will move the whole economy in a certain direction, and that's what the European Commission wants to happen. Because the European Commission has understood that the commitments they have made in the Paris Agreement, they will not be able to reach them just by using our nice European Investment Bank here next door. And so they need private capital to play the game. And SFDR, taxonomy, and MiFID will help us do it. You will say then, well, the one who will be able to claim the real economy effect will be the European Commission, and that's very true. So they have changed the incentive structure of the whole economy, of the whole financial markets, and it will work in the long term. If it's enough, quickly enough, we will see, because as you all know, it will be 6.5 years from now that we have reached the 1.5 degrees of climatic temperature increase, which will be the Paris Agreement limit. So time is of the essence, which is also why the regulatory context is so massive and so quick, and in some parts in the wrong succession of things, because CSRD comes later than taxonomy, and we need the CSRD to be able to manage the taxonomy. But one positive element is we can, instead of just complying, we can do more. We can have some effect by talking to the companies and by managing our risk like we should do. So that was about deconstructing and reconstructing. I hope I didn't shock you too much. If you have any questions, I'm here.
Any questions? It was a very inspiring speech, Thierry. Thank you. I think everyone is
They're afraid. I don't bite.
No questions? Okay. So I will have some. So you say that SRI in liquid assets works, but in other ways you would like to expect.
Yes, as I said, the real-world effects of investing or divesting in a company is very limited because companies existed before the investor and will exist after the investor. I have found recently an interesting quote by Bill Gates. Well, he's an IT guy, but he's also a very smart guy. He said that no gram of CO2 has been saved by divesting. But you can change, if you're good, if you have the right knowledge, you can change a company that emits coal from within. If you are a shareholder of the company and you make an engagement with them, you could, hopefully, bring the few arguments that might change things. But, well, normally the companies, they are not really stupid either, so they also normally know what they are doing.
What about impact investing in that case?
Impact investing, it's a nice story. It depends on where you stand. If you do impact through liquid assets, it's a little bit, well, it's a little bit of a sorry state. Because again, with this very indirect impact you can have through investing in the secondary markets. Well, at the end of the day, if you invest in impact companies to the secondary market, the only thing you can claim is that you have invested in companies that have an impact. And that's where it stops. In the green bond area, you come slowly in the gray area between the non-impact and the real world impact. If you buy a green bond, ideally in the primary market, you provide a company with cash for a certain project. And then you can claim part of this project, if this project does have real world impact. But then you have microfinance. Unfortunately, MiFID regulation does not allow for microfinance to be a very widespread product. But in microfinance, it's illiquid impact. You provide credit to the micro-entrepreneur who can then create his business. And if the microfinance bonds are even linked to environmental issues, then you can have a real impact. You will have a real, well, the microfinance typically has a social impact because it ends poverty. Imagine well, it's a little bit cliché, the African sewer who wants to buy a sewing machine, and for the 100 euros of credit, she can buy a sewing machine and create a living and sell it on the market, pay back the credit, and instead of having to pay a credit with 9% or 10% a month, they will have a credit for 9 or 10% a year. Well, it's still a lot, but it's, well, 10 times less. So over microfinance, you can have very direct impact. The others is more indirect. But I think that the GIN does do a very good job in defining where to look and what to do.
Thank you. If the direct impact you can generate in SRI is so limited, why to bother?
Yes, that's a very good question. Why bother? Well, because we have a real issue. It's no less than saving the planet, but well, the impact you can have by committing yourself to a task might be bigger. But I think bothering to do SFDR, not just by the letter, but by the spirit, will be very helpful in achieving the goals that the European Commission has. And instead of denigrating what they do, what they have planned, but playing the game would be very important. I'm always a little bit annoyed when I read newspapers where journalists talk about the misguided European green label being the taxonomy. They have it completely wrong. The taxonomy is not a label. The taxonomy is what it says. It's a taxonomy. It's a systematization of when a ex-ante polluting activity might be considered acceptable. For example, if you look at the industries that are listed in the European taxonomy, you find cement, you find, well, atomic energy, you find gas energy, you find transport, you find transport on road, on the rail, and so on. So at the end of the day, if you see taxonomy from this angle, you can say, well, we have decided that we want to have an economy. Yes, an economy has negative externalities. Yes, so if you do have these externalities, so let's create a concept which will limit these negative externalities as much as possible. And where to look? Well, in the activities which are most polluting. So, cement production, transport. And if you say, well, if you are able to produce cement according to these constraints, then it's okay. It doesn't help creating externality measurements for solar power or for wind power, because these are fundamentally sound. You need to find a concept for those which pollute but which we need. We need cement. We won't build everything from wood going forward. Would be nice, but then we don't have any trees anymore, so it won't be very helpful either.
Thank you. Last question. SRI as a means to highlight material risk that may move from extra financial to financial.
Yes, as I said before, we have activities that might not be possible in some areas. And being able to see which activities these are and where they take place might be very important for the financial asset manager. So you will be able to identify your risks early. So anyway, in SFDR, you need to declare how you take account of extra financial risk. Well, that's the reason for that. You need to know where your risks are, and that's your fiduciary duty as an asset manager. You need to be able to continue providing the performance your clients want to have. And, well, you could say it's a little bit difficult to explain your client after the fact, well, I have invested in a company that went bankrupt because of flooding, and I could have known about that. So it's the fiduciary duty of any fund manager to be able to highlight these risks and to measure them and to remain on top of things.
Thank you, Thierry. I think we have one question.
So ESG is usually a hot topic, and many people look at ESG from different angles, whether it's reporting, regulatory, do good, doing the right thing. Would you say that ESG is more of a risk management at the moment, or it's more a view of wanting to actually have a better impact?
It's both. It depends on from which angle you look. If you have, we have a lot of confusion anyway, because if you talk to the odd person who is not too much into the topic, you sense after 3 sentences that you have lost them. That's unfortunately the problem. I had recently, for example, a very nice discussion with a friend where I said, well, we are now defining sustainable assets for our fund portfolios. And she said, well, there you don't have a big choice, because real sustainable companies, there are not so many. But if you go into the technicalities, ESG is, in its essence, very helpful in managing risks. It's able to highlight things you would not have seen by pure financial research. And it will help you do better decisions. So that's the risk management angle, which, well, has been now for some time already mandatory, thanks or due to SFDR. But it's also true that ESG enables you to do the right thing but unfortunately not in the simple way everybody expects, because, as I said before, buying a good company will not change anything in the real economy. It will, as I said, affect yourself because you are responsible for a good company or for a bad one. So you feel good. But in the micro area, it's more the effect on you than on the company. On the macro area, it will have an effect if everybody does the same. But if you engage the company, if you have found the topic where a company is poor at, and you talk to the company, you engage it, you have an objective of changing the company from within, then you can do the right thing. And the company will be more future-proof, maybe more ethical, but ESG is not necessarily about ethics. It's about metrics, about a company having less negative externalities. And if you are able to change the company from within, then you will have done something right. The problem, and that's a little bit frustrating for me, as I said before, if you want to engage 400 companies, you would need, well, 400 months to get it done. So you would need an army to do that, and we don't have an army to dwell in it. But if you choose well, you could say, well, then we do 4, 5, 6 companies a year, and we try to make a difference there. And then the whole thing starts to make sense. And that's the thing our fund managers want from me. I need to provide them with sense about the whole project, because otherwise they would say, well, why bother if we don't change anything in the real world?
Thank you. Any other question? Thank you, Thierry. I think that was a very inspirational speech.
Thank you very
much. And I also do hope that everyone here in the room and online will have further reflections on what you mentioned. That's all guidance for all of us. Yeah.
Thank you.
Thank you. So I would like just to mention that our next session will start at 11. It's hosted by Canriam, and it's focusing on corporate ESG analysis.